Warren Buffett, arguably the greatest stock picker alive, has instructed that when he dies, 90% of his wife's inheritance goes into one investment. Not Berkshire stock, not a hand-picked portfolio, a plain S&P 500 index fund. The best active investor in history is telling you not to invest actively. In the next 10 minutes, you'll understand exactly what an index fund is, why it beats the professionals, and how to buy one.
First, the word index. An index is just a list with math attached. The S&P 500 is a list of roughly 500 of the largest U.S. companies, Apple, Microsoft, Amazon, down the line, weighted by size. When you hear the market was up today, that's usually this list. An index isn't something you can buy directly. It's a measuring stick. For decades, that's all it was, until someone had a deceptively simple idea. What if, instead of trying to beat the measuring stick, a fund just became it?
An index fund is a basket that holds every company in the index, in the same proportions. Buy one share of an S&P 500 fund, and you own a sliver of all 500 businesses at once. There's no manager picking winners. A computer just mirrors the list. That sounds lazy. It's actually the point. No expensive analysts, no trading costs from constant buying and selling, no star manager salary. The fund does almost nothing and charges almost nothing. The typical S&P 500 index fund costs 0.03% a year. That's $3 on a $10,000 investment. Actively managed funds routinely charge 1%, 30 times more.
1% versus 0.03% sounds like pocket change. Over a career, it's catastrophic. Take our $300 a month investor earning 8% over 40 years. In the cheap index fund, they end with roughly $1,050,000. Pay a 1% annual fee, and that same portfolio ends around $790,000. The fee quietly consumed about a quarter of the final balance, $250,000, without ever showing up on a bill. Fees compound exactly like returns do, just against you. It is the only thing in investing you control completely.
Surely a professional with a Bloomberg terminal beats a brainless list. The data is brutal. The SPIVA scorecard has tracked this for over 20 years. Across long periods, roughly 9 out of 10 actively managed U.S. large-cap funds underperform the S&P 500 after fees, and the few winners rarely repeat. Buffett tested this publicly. He bet $1 million that a simple index fund would beat a hand-picked group of hedge funds over 10 years. The index returned over 125%. The hedge funds averaged about 36%. It wasn't close. The market is millions of smart people competing. Being reliably smarter than all of them, after fees, is nearly impossible. Honesty time. 3 things index funds won't do. They won't protect you in a crash. When the market drops 30%, you drop 30%. They won't make you rich quickly. This is a decades game, not a months game. And they won't beat the market. By definition, they are the market, minus a hair. What you're giving up is the lottery ticket. What you're getting is near certainty of capturing whatever the market delivers, which historically has averaged around 10% a year before inflation over the last century. Most people who try to do better do meaningfully worse.
Practical steps. 1. Open an account at any major brokerage. For most people, a Roth IRA first for the tax benefits, then a regular brokerage account. 2. Search for a total market or S&P 500 index fund. The big ones are run by Vanguard, Fidelity, and Schwab, with tickers like VOO, VTI, FXAIX, or SWPPX. 3. Check the expense ratio is under 0.1%. 4. Set up an automatic monthly buy. Congratulations, you now own a slice of American business, and you've outpositioned most professionals on cost alone.
Not financial advice, just the math and the track record. The natural next question is which account to hold these funds in, and that's exactly what the Roth IRA versus traditional IRA video answers. It's on screen now. Subscribe if you want money explained with numbers instead of noise.
Discover the secret to long-term success. Don't just follow the crowd, build a legacy. Like and subscribe to The Long Game.